Last week, we learned that PPI, Producer Price Index, came in hotter than expected. Then we got CPI, at least CPI headline coming in hotter than expected. So I got to ask Taylor from Life Goal Investments, what does the market say about inflation? What does the market say about the Fed pivot or rate cuts? What is going on, young man? What are we doing?
Yeah, it's a really good question. We are able to look at forward expectations for inflation, and they went up dramatically. So more than I had anticipated. So they went up from 3.1 a year out to 3.8 a year out.
Mm-hmm.
So you saw a meaningful move up in inflation expectations. Now that's just the street, but the street is very important because we're all the ones making the decisions on what we're doing with our money. And the problem with inflation expectations is once they get entrenched, it's kind of a self-fulfilling prophecy. And that's where we've seen things spiral out of control in the past. But what we see now is the market has started to reprice a little bit about its Fed expectations moving forward. So it's still most likely, base case scenario, based on what the market's saying right now, is that we don't get a rate hike this year. So there's only about a 7% chance we get a rate hike in November. And then there's about a 1 in 3 chance we get a rate hike in December.
Yeah, I think this is important. And I'm going to call this a Fed pivot because I think all of this started last Sunday. So not this past Sunday, but the one 8 days ago.
Okay.
And the vice chair basically came out and said, we're done. The market has taken, like, the market moved like 43 basis points on the 10-year and since the last Fed meeting. We've also seen credit tightening, right? There was a survey by New York Fed that just said it's hard. It's the hardest on record to get credit when comparing to last year. So I really do think the Fed is pivoted, and it is no longer how high, it's all how long. And I think that is a huge pivot that not many people are talking about.
So it's a very interesting point. I will make a comment directly on the how long, which is surprising what the market's pricing in right now. But I think that Jerome Powell in his last press conference came out and said, we like the looks of the past 3 inflationary reports. And I scratched the back of my head when he said that, because the last 3 inflationary reports, in my interpretation from face value, have not been very pretty. So I was thinking to myself, what is it that he's referring to that he's so happy with? And one of the things was the underlying price of shelter coming down. Right. But last week when CPI came back out, we actually saw a little bit of a reversal there. So it was coming down and then it marginally went up. So it's one of those things where I don't see the fairy dust that is out there in the inflationary reports that they're trying to put on them. To be honest with you, I don't think they look all that pretty. And with that, the surprising point to your point is that the market is saying, listen, they're not going higher from here, but how long are they going to stay there? And the market right now for next year is pricing in 3 interest rate cuts in 2024. And I look at it and say, man, 3 interest rate cuts in 2024, and inflation still is a little bit of a problem right now. And the last 3 inflationary prints, although the Fed said they were good, I don't see them as being so pretty. I'm not sure.
Yeah, it is. Well, let's talk about the market. Again, this is my opinion. You've been on the street for 10 plus years. I think the market, at least in this rate cycle, has clearly been optimistic.
Oh, at every intersection.
Every intersection. So the fact that the market is calling in 3 rate cuts next year, I call BS. And you've been wrong for 18 months. Change your playbook, right? You look at different things.
And for context, at one point from where we're at right now, they were pricing in 5 interest rate cuts next year. Right. So we've already baked 2 of them out of that cake.
Yeah, it's interesting. But I really, at this point, to me, I do think the conversation over rotates to a recession. It still feels to me, and I've made the call, so I'll stick with it, that a recession starts Q1. Q1's the first negative quarter. And the real question is going to be, is it kind of short and shallow like we all hope, negative 0.1, 0.2, 0.3 kind of negative? At that rate, I don't think the Fed cuts. If we get a 1.4, the Fed starts tinkering. So
here's the interesting thing from the other side. One, I'll say Paul Tudor Jones said the exact same thing. He agrees with you that Q1.
Oh, wow.
a recession will start. So that's not a bad guy to have in your camp.
I like it. I did not know that.
He's an icon. He is an icon. Yeah. You put him up against, basically anyone. Ray Dalio, he's right in that same conversation. Here's the interesting point when it comes to the actual markets. So let me, because you always do this to me, so let me do it back to you. What do you guess that the market is pricing in from an S&P 500 earnings perspective next year?
Oh God, the market's always rosy. I'm going to say plus 12%.
Nail on the head. Plus 12%. You are the man.
I've done this a while.
No, hell yeah, but that's awesome. So you literally hit the nail on the head. So try to write this to me though. Write these ships that are moving in opposite directions to me. The markets say, okay, 3 interest rate cuts. That's a pretty brutal economy that would have to play out in order for that to take place. And on the other side, 12% earnings growth in S&P 500 companies. That's just, it's just one of those things where you can't have your cake and eat it too, right? And that's what's being priced in on both sides.
I agree. The market often does kind of play both sides. And it's funny. I don't think you get 3 rate cuts, and I don't think you get 12% earnings growth. Right?
I'm 100% with you. 100% with you. It's in between on both of them. The rate, the interest rate, the earnings are not that good, and the interest rate cuts are not that good.
Yeah, there's one more thing. I have a stock guy on Sundays now, Dan Bird, and one of the things that he showed me, I don't know if you have these indexes or you've looked at them, but apparently there's a small cap index and a mid cap index.
Yep, the Russell 2000 small cap index.
Yeah, so both of those have rolled over in really noticeable ways.
Yep.
While the bigger companies have not.
Yep.
And what I proposed to him, and I'll just let you react off the top of your head, is I think what you're seeing in the small cap, because the small cap rolled over hard, mid cap has just started to roll over, is higher interest rates and tight lending conditions.
100%. 100%.
So I think that's what I think the Fed is seeing.
Yep.
Right. When the Fed looks out there, they're seeing the I don't want to call it the weakest, the smallest, whatever you want to call it, get hurt, then the mid caps. And the question is, how high do we go? Right. The Magnificent Seven, dude, they print money, not going to be impacted. Doesn't matter. Just doesn't matter. Where does
I'll look at this on both perspectives, because I think you just hit the nail on the head on the one side. But on the low side to start, being the Russell 2000, being the small cap index, that has a massive weighting towards financials. That's one of the reasons it's gotten pounded so badly, is that financials and regional banks are such a massive impact upon that space. And they've obviously, they got up off the mat a little bit after the SVB drawdown. They drew down massively. They got up a little bit, and then they've been since pummeled. And every time we see an inflationary print that comes out the tot and the Fed has to react to that, they get hit again. And so that's one of the reasons you've had such a massive impact in the Russell 2000, which is the small cap index. But to your point, if you strip out, so the Russell 2000 is up, I believe, 1.2% this year versus the S&P up somewhere in that 14% ballpark. But to your point, when you strip out the Magnificent Seven, the S&P is very ho-hum from a performance standpoint as well. But you hit the nail on the head. The fact is, big Magnificent Seven companies that print money, they do not need to lend. Or I'm sorry, they do not need to borrow. They don't need to borrow. So that does not impact them whatsoever. And then their cash reserves that they sit on, they're like a bank. They go out and get, 5-6% on cash reserves. And they're very, very smart. One of the biggest bond portfolios in the world, I actually believe it's the biggest bond portfolio in the world, is Apple's cash. Is literally larger than any other bond fund in the world. Wow. And so you look at it and go, okay, I get why higher rates is actually supporting them. And you know what it also does? Stymies out growth of new competition coming in.
Oh, yeah.
Because
you can't,
the IPO,
IPO windows closed. Yeah.
IPO windows closed. Private market lending is closed. Private financing is closed. It's they can't get investors from anywhere.
Yeah. Very, very cool. Well, let's talk about banks on our next episode. But before we do that, where can people find you?
Yeah, thanks so much. Find us at Life Goal Investments on both Instagram and on TikTok. You're the man, Michael.